We are opening the file today on a financial move that, while it's happening pretty quietly in Hong Kong, it really tells you a lot about global investment strategies.
It absolutely does. We're talking about Blackstone, the world's most,
Wow.
well, just this behemoth of a real estate fund manager.
And they're moving into a brand new sector.
Yeah.
In one of the world's most complex property markets, no less.
It's basically an institutional signal flare. Our sources are confirming that Blackstone is in the final stages. I mean, we're talking advanced negotiations.
To acquire what exactly?
2 key service department blocks from Chi Residences, who are a prominent local operator.
Okay. So for you listening, our mission today is a bit complex. We aren't just tracking the money here.
No, we need to understand the strategic why. Why is a massive global player like Blackstone entering the Hong Kong rental market right now? And, maybe more importantly, what is driving a local seller to accept what looks like a jaw-dropping discount?
Right. The core insight here, the real aha moment, is that this deal, if it goes through, marks Blackstone's undisputed debut in Hong Kong's rental residential sector.
It's not their usual playground at all.
Which tells you they see some kind of stability, maybe predictable returns here that they just aren't finding somewhere else.
It's the very definition of an opportunistic entry. They're capitalizing on very localized financial distress to make a major long-term bet.
Okay, let's unpack this, starting with exactly what they're trying to buy.
Yeah, let's get into the assets.
Because these aren't just empty condos. They are purpose-built, operationally intensive service departments. They cater specifically to that extended stay market. Think corporate relocations, long-term business travelers, people who need a managed living environment for months at a time.
And that segment is famously resilient. And resilience is exactly what institutional investors are hunting for right now.
So what are the specific properties?
Specifically, we're looking at 2 established properties. First, you've got Chi 138. That's 107 units in Wan Chai, a critical business hub.
Okay.
And then there's Chi 314, which has 59 units in the busy Jordan area.
So that's a total portfolio of 166 operational units.
Exactly, 166 units that Blackstone is aiming to bring into its fold.
Now for the price, the proposed price. Sources are saying the deal is valued at approximately HK $750 million.
Which is what, about US $96 million?
But the real measure, the thing that tells you about the discount, is the unit price. Blackstone is reportedly getting these for around HK $4.5 million per unit.
And you really have to put that figure in context. HK $4.5 million, that's roughly 575,000 US dollars.
For a service department in Wan Chai or Jordan.
For a unit in prime central districts, it's almost shockingly low, even for a soft market. That's a valuation you'd expect to see way out in secondary districts, not in these core locations.
So if the price is that surprising, we have to look at the deal structure. What's the status right now?
Currently, the transaction is locked in what's called exclusive due diligence.
So what does that mean for them?
It means Blackstone has the sole right to go through the books. They're examining the financials, the debt, the physical condition, the operational stability, everything before they close.
They're not just kicking the tires.
Oh, no. They are in the garage with the mechanics, making sure there are no hidden flaws.
And this brings us to a really critical piece of the puzzle.
Yeah.
The partnership angle.
Right, because they aren't doing this alone.
We understand they're working alongside Dash Living, a major rental housing operator in Asia, in these discussions.
And that alignment is absolutely essential. You know, running service departments is much closer to running a hotel than just managing a rental block.
It's a hands-on business.
May vary.
Yeah.
It requires active management, cleaning services, maintenance, getting those corporate contracts. So Blackstone brings the massive capital, the muscle, but Dash Living brings the crucial local operational intelligence.
So they're buying the operational stability along with the brick and mortar. Okay, so if the buyer's side is so strategically sound, then all this pressure, this massive discount, must be coming from the seller side.
That's exactly where the story pivots. You look at Chi Residences, founded by Philip Mores. This sale isn't just some normal portfolio rebalancing.
No, it feels more like a desperate financial extraction driven by a very tight deadline.
It does. And here's where we see the mechanics of a distressed sale really play out. Let's look at this financial gulf.
The discount.
We have to analyze the discount because this is the high-impact insight that matters most. If this deal closes at that HK $750 million figure, Chi Residences is liquidating these properties at a brutal discount.
How much are we talking?
potentially 43% off their recent valuation.
23%. In real estate, that's not a discount. That's a fire sale.
It is,
Yeah.
especially when you contrast it with the valuation figures from just a little while ago.
How recent are we talking?
Back in March 2023, independent estimates had these exact same two properties valued at HK $1.65 billion.
Wow. So in less than 2 years, the value dropped by nearly $1 billion Hong Kong dollars.
A drop that drastic requires immense external pressure.
And our sources are pointing to the source of that pressure.
Debt.
Mm-hmm.
The driving force here is reportedly the imminent maturity of a massive HK $1 billion loan from HSBC.
There it is.
This is a classic case. Debt maturity is dictating market activity. When a $1 billion loan is due and you don't have the cash or the ability to refinance in a tight credit environment,
You're forced to sell assets.
you're forced to sell, even at a massive loss. And this shifts every single ounce of negotiating power to Blackstone.
They know the clock is ticking.
They know, and they can demand deep, deep concessions because the seller needs that cash now.
So effectively, Blackstone is getting this huge discount, not because the assets are bad, but because the local operator's balance sheet is under just extreme duress.
Exactly.
But let me ask a skeptical question here.
Yeah.
Is there any suggestion that the properties themselves are, physically degraded or operationally inefficient? Or is this purely a debt-driven fire sale?
That's a great question, and all indications point to this being purely debt-driven.
Okay.
These are established, core-located service departments. If they were operationally flawed, Dash Living probably wouldn't be interested, and the deal wouldn't be an exclusive due diligence.
And they were on the market before, right?
They were. The fact that these properties were marketed earlier as part of a much bigger portfolio valued up to HK $2.2 billion back in April 2022, it confirms the market saw real value in them.
So the problem isn't the asset, it's the timeline.
It's the timeline for liquidation. The urgency is palpable.
To go from marketing a portfolio at over HK $2 billion to selling two key pieces for less than $500 million USD, that just shows the sheer force of liquidity needs when a major bank loan is coming due.
Exactly. And this allows Blackstone to enter the market not through competition but through crisis, which leads us to their bigger strategic motivation. This shift isn't an accident.
Right. They weren't strangers to Hong Kong. They just played in a different sandbox before this.
A very different sandbox. Blackstone has been a huge player in the Hong Kong industrial market. We're talking logistics, warehousing, data infrastructure.
They invested over HK $2.5 billion in that sector through their joint venture with Store Friendly.
A big bet on e-commerce and logistics growth.
So if they were so heavily invested in industrial, why pivot now to rental residential?
It's all about finding resilient yield. Industrial logistics saw a boom during the early pandemic years, right? But that sector is maturing. It's getting incredibly competitive.
And rental residential offers a different risk profile.
A fundamentally different one. If we connect this to the bigger picture, this move shows Blackstone sees greater stability in these long-term income streams from, say, corporate tenants and extended stay solutions.
Than in pure warehousing speculation.
Exactly. They see more resiliency there.
And you can see why. Service apartments are attractive to these global funds because they often offer higher yields than traditional residential rentals.
And their occupants? They're a less volatile group.
Often business travelers, corporate employees relocating. This type of client is less sensitive to short-term economic hiccups than, say, tourists or luxury home buyers.
That segmentation is absolutely key to understanding why this asset class is seen as so resilient. When the broader commercial property market like office space or retail is slowing down, demand for stable, flexible housing for professionals traveling across Asia-Pacific stays pretty robust.
So this is a bet on the ongoing activity of the business world itself.
Which needs these kinds of extended stay options, yes.
Now, before we zoom out completely, we should acknowledge that for Chi residences, selling assets isn't new. This is part of a longer pattern, even if this particular sale seems distressed.
Oh, it certainly establishes a history. Chi Residences has consistently been monetizing their service department assets. They sold the 19-unit Chi 120 in Sai Ying Pun for HK $188 million just this past July.
And if we look back further, they sold an earlier property, the Chi 138, this one in Sai Ying Pun, back in 2018 for HK $730 million.
Right, which was eventually rebranded as the Connaught Hotel.
Then there was the sale of Chi 393 in Yau Ma Tei in 2019 for HK $183 million. So they have a history of converting properties into cash.
What makes this current deal so different is the sheer scale of the discount and that external debt driver, but it also reinforces a broader market trend we're seeing.
Which is,
Institutional investors are flocking to this specific niche. Blackstone is not alone in seeing this opportunity.
no, they are not. We've seen other major institutional players making similar moves in Hong Kong's rental residential space.
Exactly. We know that Crystal Investment and PGEM Real Estate have also partnered with Dash Living for acquisitions in this very same segment.
So this raises an important question. Why is this specific segment attracting so much global capital right now, especially through these partnerships?
It suggests a consensus, I think. The belief is that in a high-cost city like Hong Kong, where traditional housing is just extremely expensive, the middle ground that service apartments provide offers flexibility for the user.
And predictable, managed cash flow for the institution.
Predictable cash flow is the holy grail right now. Large funds are desperate for yield stability.
And the operational flexibility of service departments, being able to adjust pricing and occupancy strategies much more nimbly than standard long-term leases, that has to be incredibly appealing in an uncertain economic climate.
It is. And that operational flexibility combined with a chance to buy prime assets at a 43% discount because of a competitor's debt issue.
It's the perfect storm for Blackstone. They seize the asset, they lock in the local expertise with Dash Living, and they enter the market at a valuation far, far below its historical peak.
It's financial opportunism at its most calculating. They are acquiring stable assets at a distressed price. Simple as that.
So what does this all mean for the city's real estate future and for you, the learner? We've established that global investment capital, specifically Blackstone, is betting big on the resilience of Hong Kong's serviced apartment sector.
And they are doing this by capitalizing on the acute financial pressure that local operators like Chai Residences are facing, all driven by that enormous HSBC loan maturity.
For the local market, it seems to mean ownership continues to shift toward these global institutional players who prioritize long-term, stable yields over quick flips.
And for the business traveler, it probably means more standardized, professionally managed, extended stay options, all backed by that global capital.
So what does this all mean?
Well, it leads us to the final provocative thought we want you to mull over. This transaction, it starkly highlights the dynamic tension between global real estate funds who are seeking these multi-decade income streams in resilient sectors.
And the severe impact of local, short-term debt maturity cycles.
Exactly. This suggests that future major market activity in Hong Kong might not be dictated by, organic growth or government policy. It might be dictated by institutional investors who are strategically positioned to capitalize on the unavoidable liquidity needs of local operators.
So the advice is,
Keep your eyes on the maturity schedules of major local debt holders. They might just be the most reliable indicator of where the next big acquisition opportunity is going to come from.